Hello investors, thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about Teladoc. Teladoc just reported its Q4 results, Q4 2021. Gonna go through that. We're gonna talk about the good aspects here and the bad aspects. So this is the context, right? So Teladoc is down approximately 75% in the past 12 months, okay? Everyone is talking about Teladoc just being a flash in the pan, a COVID winner, this, that, the other, and the stock is just gone obliterated. But as we go through, you're going to see a business that is actually growing, and you're going to see a business that where members are actually still increasing. You're going to see a business that is reporting solid guidance. We're going to discuss the good and bad aspects of its path to profitability. And yeah, I'm going to always talk about the valuation here. So just going to jump right in. So as already alluded to here, the stock has been absolutely battered. And the after earnings reaction was kind of the stock popped at first when, they put out very strong 2022 revenue guidance, but then kind of people like, and the stock kind of sold off. But I think if you go through this, I think that you're going to think, okay, it's probably not so bad. It's probably like worthwhile kind of thinking about this one. So last month when I covered Teladoc, I said that there are very few investors that today look at Teladoc with anything but negative emotions. All kinds of narratives are built around why the stock is down. Too much executive compensation is the one, COVID winner, too much competition. The list goes on and on. I'm confident that you can add a few more quote-unquote reasons too. Then I went on to say that the big news from the Investor Day was that management reassured investors that it has what it takes to grow over the next fiscal year at somewhere between 25 to 30% CAGR, okay? So with all those elements out, and let me just kind of add some further context, right? So the guidance here is that they put at the high end is 31% year-over-year growth rates, okay? Now, just let's stop for a second. So obviously Q1 looks kind of a bit lackluster, but you have the very strong Q1 of last year. That was just like bang, So coming up against that, obviously it was always going to be difficult. Management was also very, very clear on the call. Several times they noted that there's going to be sequential revenue growth rate. So Q1 is going to be slightly weaker, and then as we kind of progress out of there, it's going to be looking better. That is back end weighted. So that's something for you to think about as well. Okay. Now here's a earnings surprise, the revenue surprises from Teladoc over the past several quarters. You can see that management consistently puts it lower and beats estimates. Now, let's be honest, right? These beats are marginal, okay? We're not talking about large beats. So when the stock is down 75%, listen, beggars are not choosers. You gotta, at some point, you still gotta start thinking to yourself, okay, let's be honest here. What are the expectations for investors? Because everyone's kind of thinking about this thing is dead. And, when you kind of just have that context in mind, you always start thinking, okay, 30% growth for you isn't such a bad thing. Okay. Now, so as you probably know already, so Teladoc is a telehealth business. But what is particularly interesting that I found is here that the number of visits, total visits, is up 41% year over year in Q4 21. Okay, think about that for a second. Patients now have the options to go to the regular visits to the doctors, and even in that context, also the context where they last year in Q4 they didn't have that many options. They were probably not that comfortable to do visits, and so there was a large spike last year, and even against a large base. This year, they still were up 41%. 41% is nothing to sneer at. So when everyone is talking about this business is just a flash in the pan, I think, okay, look, you can bring your stories, but I'll bring you my facts. So yeah, I think that's worthwhile talking about. During the earnings call, they also talked about that multi-product sales represent approximately 80% of full year bookings. So people are coming in for more than one thing. Maybe people coming in to just talk about, some physical pain, or maybe they come around and they say, okay, actually I want some mental health issues that I'd like to talk about. Maybe they were talking about some kind of acute pain, some chronic, complex. So that ability to be the first place that patients go to remotely access on-demand healthcare is Teladoc. So they're doing well in that respect. Now, let's be honest, right? There was obviously a large amount of revenue growth that got pulled forward, and we saw that last year, and also they made the huge acquisition of Livongo. But even against that context, the business is clearly not a flash in the pan. It has what it takes to grow, and the business has been left for dead. But it's clearly not dead, as we've already discussed ample times. Now here, let's discuss the problem, right? I mean, this is a tough one, right? So you look here, and you can see that the big issue that came out throughout the whole of last year was, okay, you're getting paid way too much stock-based compensation. How are we gonna do so we bring that down? And it has come down. It came down from 476 million in 2020 to just over 300 million. So this meaningfully come down. That being said, of the adjusted Ebitda number, stock-based compensation still makes up more than 100% of that number. So it's kind of a tough one, right? It's like, one could argue that the business is kind of being run for the sake of the executives at this point. So the other thing to think about is if your stock is down approximately 75% and all your management team is getting paid on stock-based comp, you kind of think yourself, okay, what's the value of that stock-based comp? They're going to have to supplement that with some cash bonuses if they want to retain that talented executive team, particularly the Livongo people, which many of them just kind of like, okay, cash in, bye, I'm gone. So you got to think that through a little bit. So it's a tough call on the bottom line profitability one. That being said, listen, when it comes down to, I think that a lot of that has already been priced in, right? Because the stock now is priced at pre-pandemic levels, right? So it's actually, if I look back, there were periods in 2019, way before the pandemic even kind of surfaced, that Teladoc was being priced at a relatively the same share price as it is trading at now. Okay, so you kind of know that this business has what it takes. You know that it's well disposed to benefit from the digitalization of healthcare. So you know all these facts. You have all these question marks already. A lot of the uncertainties already come off the table, and you're still getting that really attractive valuation. Secondly, you get to see a business that they acquired Livongo for 18.5 billion. So right now, the market cap of Teladoc is approximately 10 billion. So for 10 billion, you get Livongo for free, right? So it's kind of interesting to think about it in that way. To put some numbers to this, Teladoc is priced at approximately 30 times this year's Ebitda figure. Now, I know we already discussed about the adjusted Ebitda number being kind of but in that context, it's still growing at 30%. So you got a business that's not going away. You got a business that has what it takes to modernize healthcare. You have a business that is still not looking to maximize profitability. They still got a large runway ahead, and you're paying 30 times Ebitda. So I kind of think this is kind of interesting. But until they seriously bring down those that pesky stock-based compensation, and I see some really solid cash flow generation, I'm not going to get involved here. What I'm getting involved with is some names that are even in healthcare that are really exciting right now, and I'm looking to buy right now. So if you want to find out those names, don't forget to check out my marketplace. It's called Deep Value Returns, right there above the screen. Come on board, check out what other people said, see the reviews, get involved, and I hope to see you soon. Thank you so much. Bye-bye.